All right. Hey everyone, and welcome to this week's Gap Shop on Personal Financial Planning, organized by GAP, the Global Association for Planning and Strategy Professionals. My name is Nisha Katwani, and I'm the community manager here at GAP, and I'll be moderating today's session. Today's Gap Shop will throw light on personal financial planning. Joining us today is Neeti Sethi. Neeti is a certified financial planner, having her own practice for over 10 years. She is also a chartered accountant by qualification and has been a founding member and treasurer of Council of Financial Planners. Her corporate stint prior to current practice includes working with Infosys and ICICI Bank. During this session, she will help us demystify the money puzzle and sharpen our financial acumen, understand why one should save, what are financial goals, where to invest, the tax angle, common mistakes, investment mantra. Neeti, welcome. It's great to have you.
Thank you, Nisha. Thank you for the introduction and good morning, everyone. Thank you for joining on a Friday morning. So I'm not sure what is it I'm going to be able to cover in 40 minutes because, this topic kind of, easily takes a couple of hours when we do it otherwise. But I'll try and see how much of it I can, do it in a 40-minute session. So I'm given to understand that, the
Nikki,
audience.
sorry, before you begin,
Yeah,
I would just like to put it out there that
yeah.
this will be a recorded session, so our members can watch it later. Also, the purpose of these talks is to foster learning. So request everyone to share your views, questions, and opinions after the talk, or you could drop it in the chat box. Yeah, over to you, Neeti.
Okay, thank you, Nisha.
Yeah.
Yeah, so I was saying that I've been given to understand that there'll be a mix of crowd here, but mostly this is keeping in mind young investors, probably the ones who are just starting out or have been working for a couple of years. I think it'll be a good session for them. For the others, it will be more like a refresher. So it's no harm going back to fundamentals and just making sure that you have been doing things right. So let us start. I don't want to waste any time. I know I have less time. So this is what I intend covering today. So the first four things that you see are the basic, fundamental pillars of your personal finance, right? And this is going to be true for just about everybody who is, listening to this. The other couple of things are probably, some do's and don'ts around the area of personal finance. So yeah, I mean, the reason I'm using a presentation is, of course, twofold. One is that, you don't have to keep looking at me and, I know how this works because after a while, you won't be listening to me. You'll just keep looking at me, and she's doing something. So we have something to look at. And the other thing is that I've been in this field for very long. So it's very easy for me to lose trajectory, bhavnaon mein behkar, I will go all over the place. So this kind of acts as a reference to me, to kind of stay on track and make sure that I don't deviate too much, right? So let's start with the first thing that I would like to share with you guys. And there is a reason I've put 3 exclamation marks after save money. So this, to my mind, is the absolute critical thing which one needs to start with. And this could start with as early as childhood, and not when you start working, because a lot of time as children, we get gift money, we get money from our parents for odd jobs done, we get money from our grandparents. So I would think if some of you here are parents, you could inculcate some of the concept of saving as early as childhood. And possibly this is the most important piece, because nothing happens without setting aside something from your income. So let's look at how people typically try to look at savings. So a lot of people I've met, right? I mean, they earn a lot of money. Some of them earn a lot of money. Some of them have just started out. And usually the objective is that, we want to have a decent lifestyle. At least when we start earning, there are some things which we've not been able to do. So the moment you have that paycheck, suddenly that gives you a choice to do things which you've never done before. And a lot of time this mindset kind of continues into future. So this is absolutely fine when you're starting out, you got your first paycheck and you continue like this for a couple of months, that okay, I'm earning a certain amount of income and I'm spending it on various things and I'm enjoying myself. It's absolutely okay so long as you do it for a couple of months and maybe a year. But when this continues as a habit into your middle age, that is where problems start. Because with a lot of people, I've seen that income keeps growing, but the expenses also kind of move in tandem. So you are possibly not saving enough. So there is a reason why we need to save. So long as we were able to earn throughout our lives and use up that money to live our life, it is absolutely fine to not save. But fact is, there are so many things in our life. You're going to need a large amount of money, which cannot come from our 1 or 2 month or 3 month salary. So these are some of the reasons that we need to possibly look at setting aside something for the future. So I think we are in the post-COVID era now, and I can't, harp enough about emergency situations. So we've seen job losses, we've seen health issues, we've seen hospitalizations, we've seen all of that in the last year. So I think there is some sense amongst people now that we need to set something aside for situations which are completely unplanned or hit us out of the blue, right? So that is one reason that from the kitty that you earn, you need to set aside a little bit and put it somewhere. We'll discuss where to put it. The other thing is fulfilling your needs. So it's okay that your income takes care of your living expenses, possibly your EMIs, your shopping, your travel, and all of that. But at some point in time, you are going to have to have money for the big ticket items, right? So let's say you want to buy a car, or you want to invest in a house, or you want to plan a fancy foreign vacation. Now this definitely cannot come out of your income. Yeah, it can't come out of your immediate income. So it is very, very important that you have something planned for some of these needs which may come along, and possibly some of the wants, right? So your goals can basically be classified into things that you need to do. For example, your kids education, possibly your retirement, and some things you want to do, like possibly buying a house or investing in a property, buying a car and stuff like that. Nisha, just give me a second. I'm just going to minimize this. It's very distracting.
Sure.
Okay. Yeah. So that's the reason we need to save. And let me just kind of take you through, the life cycle of how a typical, let's say a salaried person's life kind of fits on a scale of age and income. So in your young years, of course, the primary focus is on gaining education, improving, upskilling yourself and gaining knowledge, etc. And at that point in time, you don't have access to any income. So it's your parents who fund it, and possibly, for your education, etc., you may take a loan. Now, the moment you move up, right? So you start your early career and you have income. There are certain goals which come to your mind at that point in time. So it could be, a higher education for yourself. Maybe you need to plan for your marriage. You need to buy a car or a bike or whatever else, right? So that you will realize, again, partially may get funded by parents, or you could take a loan. But it is at this point in time that the relevance of saving kind of kicks in, that there are few things. So for example, even if you are buying a house, the bank expects that a certain amount of money is paid from your side. So let's say if 100 rupees is what you need, bank expects that at least 15 to 20 you have to put from your pocket, and the rest of it we will give. So for that 15 to 20, you have to be kind of setting aside something to be able to reach there. As you move up, and get to the middle management, possibly I could say 30 plus, mid 30s, early 40s, etc. Uh, there's a good chance for a lot of people that they are married and they have kids. So suddenly there's child education. Probably you want to invest in a house or a bigger house, maybe a second car. There are vacations. Probably you want to hone your skills further in your career. So all this is going to require money. And let me tell you that, this money will not come from 1 or 2 or 3 months income. So there has to be some kind of kitty that you set aside to be able to take care of these big ticket items. Now, as you move to senior management, possibly similar kind of goals. People like to improve their standard of living further. And then, of course, there's kids' higher education, their marriages, and all of that. So at this stage, while you're still working, possibly you can take a loan, but heavy reliance will still have to be on your savings, because you would have completed at least possibly 20-25 years of your working life, and at that stage you should have enough to take care of some of these important or crucial milestones in your life. The last bit, I think, which is very important, is retirement. And most of you would agree that we spend about 1/3 of our life in retirement. So when I say retirement, assume that there's no active income flowing in. So the tap has kind of stopped. The tap which was flowing all your life has now stopped, and you have good 1/3 of your lifetime, anywhere between, let's say, 20 to 40 years remaining, where you still need to live and you still need to do all the things that you want to do, right? And this is where it becomes very, very critical that you have built that pot. So while you had that tap flowing, you were able to accumulate it in a pool, which later will help you to do all the things that you can do. So if you ask me, I think for a lot of people, when they are in their 20s or maybe early 30s, retirement is too far-fetched or too long a goal to be able to think about, I think. But this is the one which is most important, and it's really, really critical to start early, uh, planning to plan for this goal. I'm sure some of you are aware of this new age term called FIRE. So a lot of financial plans that I do right now, one of the goals which people specify is FIRE. So FIRE basically stands for financial independence and retire early. So now we are in a very different working environment as compared to our parents. So nobody will raise eyebrows if somebody says that they want to retire or become financially free in possibly their late 30s or early 40s. So FIRE is all about that you don't want to continue to work as long as 60 years. Maybe you want to have that choice to be able to do what you want to as early as your 40s, or maybe FIRE is actually 40s. It doesn't even get to 50s. But of course, working with clients, this is the goal which we have really been chasing, which is financial freedom. So it's not about the fact that you want to stop working at a certain age, but it's about the fact that you need that choice, that whether you want to work for money, whether you want to continue in your existing job, or you want to do something else. And only money can provide you that kind of choice. So it is very, very important that to plan for this, we need to start somewhere here, right? So this is another thing which is very common when people start out, that the typical tendency is that, I get my salary or I get my income in, the first week of the month, and I usually spend it on whatever I do. And possibly I have some money lying around in my bank account towards the end of the month. So the equation typically is income minus expenses is savings. That is how we truly understand it. And that is how it possibly makes logical sense also, that I spend what I have to, and what I'm left with is my savings, and I'll probably do something with this, something with it. Now, I just want you to think of this a little differently, and perhaps turn it on its head, that you pay yourself first. So before paying your EMI guy, or before paying your grocer, or before paying, for shopping, etc., you pay yourself first. So you first save, and then whatever is left you spend. Now you may ask me, how do I decide what can I save, and how do I know that the rest will be enough to take care of my expenses? Now that's not a tough maths really. So just estimate what's a typical month like, and what are some of the expenses which happen annually, and just estimate that on an annual basis, what is it you're drawing in as income, and what is it that you are spending. The rest of it is actually your savings. So let's take an example. So let's say you're earning 10 lakh rupees a year, and on an average your expenses are about, let's say, 7 lakhs, for example. So 3 lakhs is possibly what you can save. So you draw up a plan in such a way that this 3 lakhs, you divide it over 12 months and you start saving that amount. So for example, 25,000, that's correct, 25,000 rupees is what you decide that as soon as I get my income, in the first week of the month itself, this 25,000 is going to disappear from my account. So where it goes into, we'll see a little later, but it has to move out of your account and you manage with the rest. Also with saving, I think it's very, very important to set some stretch goals. So you're not doing a favor to anyone by saving. So remember that you are doing it for yourself. So often I tell my clients, you have to have stretch goals around saving. So when they say, "Acha, 6 lakh ho jayega, ya 8 lakh ho jayega, ya 10 lakh ho jayega," I push them to go a little higher, and I tell them, this is, so let's say we start with 12 lakhs, if 10 lakhs is what you're thinking you will be able to do. So we start with 1 lakh of rupees a month, and somewhere down the line, if you feel you're bahut zyada stretch or I'm not able to do it, we'll go down. But let's start with 1 lakh. And trust me, almost every time we've not gone back from that figure, right? So give yourself a stretch target. And let me tell you, even if you can't see what savings can do for you right now, at some point in time in life, you'll be very, very thankful that you set aside something for the future. Right. So that's about savings. Let's move ahead, and we'll come back to savings when we discuss investments. Now, this is something I picked up from Morgan Housel's book, The Psychology of Money. If you haven't read this book, I would absolutely recommend to pick up this book. For some of you who are still young in your 20s or 30s, I think this book perhaps has the potential to shape your thinking about money and finances, and how do you perceive things, because it's got to do a lot with psychology, very less with technical stuff and number and stock markets and all that, right? So it doesn't matter how much you're earning, because I've seen people who are extremely, if you can call them rich in terms of the income that they draw, but very poor in terms of savings. And it even doesn't matter what your investment is going to earn. So it may earn a 50%, but if you're putting very little, it's not going to do much from you. So wealth creation has almost everything to do with how much you can save, right? Let's move to the next building block or the next pillar. And I think contingency or emergencies, it's easier for me to explain to people about these things, having gone through 2020. So, some people may have experienced loss of job or reduction in income, or even a, health issue in the family, hospitalization and things like that, where you realize that bulk of what you have accumulated is gone in one shot without even realizing, uh, that something like this could happen. So trust me that at some point in your life, a emergency will hit you. If it hasn't hit you so far, you're very lucky, but you need to be absolutely prepared for it. So when we say that, after you save, the first thing that you do is build a contingency fund. Now, contingency fund is basically an emergency fund to take care of any of the things which are listed on the screen ahead of you. So this is basically something which requires a large amount of money, and which hit you out of the blue. You were not prepared for it at all, right? So now, question is, what is a good sum to be able to do it? So again, it depends on situation to situation. For example, if somebody is, someone's job is in a turmoil, I would say that, you plan for at least 12 months, because we don't know what's going to happen tomorrow. If there is a couple who is in a stable job, right, both of them are working and jobs are quite secure, even a 3 to 4 months contingency is, so, it could range anywhere between 3 to 24 months. So, for example, somebody wants to quit their job and start something on their own and experiment for a year. I would say, okay, just plan for 2 years expenses, so that if you draw absolutely no income for 2 years, you're still good to go, right? So figure out for yourself. And when I say 12 months or 3 months or whatever months expenses, these expenses are things which you can't do, which you can't do without. So for example, your living expenses, possibly your EMIs. If you have kids, then there's schooling expenses. Probably you can remove things like traveling, or give a lower weightage to shopping and things like that, because those can be controlled if things are not good. But the ones which you would have to do irrespective of whether you're making money or not, that is going to be your multiplier, right? And so what do you do with this money? Ideally, don't leave it in the SB account. So for example, if I'm spending 50,000 rupees and I want to keep a 6 months contingency, which is about 3 lakhs, if I see that money sitting in my SB account all the time, there's always a tendency to perhaps spend it on something. So, I want to buy a fridge or I want to upgrade to a TV, and I say, okay, I have money lying around, so I can just do it. So I think don't do that mistake. Perhaps keep 1 or 2 months expenses in your SB account, and that's more than sufficient. The rest of it, you park it into an FD, or you park it into a safe debt mutual fund, right? I think FD is good enough. So just go ahead and push it into something which is out of sight, but at the same time something which is safe and which is liquid and which you can get within 24 hours. So this is absolutely critical to do. And I think before you start into any kind of investment plan, it is very, very important to have a contingency plan in place. So you may not have the entire 3 lakhs in one shot, but you make sure that, if you're saving 25,000, at least 20 is going towards your contingency fund, and maybe 5 you can start with the regular savings, right? So that is the second most important thing to do in terms of what you need to do to set your financial life in order. Now, the third important thing is insurance, and you would notice that I haven't come to investments yet, because for a lot of people, the preoccupation with investments, usually leads to not taking care of some of the other important stuff, right? So when I say that you need to save and you need to have a contingency fund and you need to insure and you need to invest, it actually has to go in that order. That is what I'm trying to imply. Now, unfortunately, in our country, insurance as a product still has to be sold. And in order to sell it, it has to, kind of take this garb of investment. So let me tell you that insurance is not an investment, and please separate it from investment. So if you're buying insurance for the purpose of investment, I think it's a bad idea and possibly you should not do it. So let's look at why you need insurance and what are the kind of insurances that you need. So I think the first most important one and the most talked about is life insurance. So there are two criteria that you need to see to be able to judge for yourself whether you need life insurance or not. So the first thing is that if you have any financial dependence. So if you're taking home an income and there are people living off that income, right? That means that there is somebody who is financially dependent on you. It could be your spouse, it could be your kids, it could be your parents, right? So the moment you have someone like that, you need to have life insurance. The second could be that if you're having any loans, so let's say you have any liabilities on your head, you may not have dependents, but you've taken a home loan, for example, right? In this case, the bank will actually make sure that you have insurance, because if you're not there tomorrow, they still need to recover their money. So if these two criterias are met, then you need life insurance. So I have a client couple who are in their late 40s. They don't have kids, they don't have financial dependents, either in terms of parents or anybody else, and they are having their goals, whatever, typical buying a house, retirement, and stuff like that, and yet they don't need insurance, right? Because there's nobody who's depending on their income, right? So the two criteria that I said have to be met to be able to buy life insurance, right? So this bit I covered. And how much insurance should you take? So there is actually a working or a formula around it. So I don't believe in thumb rules, although I've given you a thumb rule here that you could take 8 to 10 times of your annual income. Uh, Thumb rules usually don't work because each situation is very, very different from the other. So just to give you'll find a number of tools available online which will help you or guide you to find the right amount of life insurance cover. But just to give you an idea of what your insurance should cover is that if something were to happen to you tomorrow and you're not there, your family should be able to continue to enjoy the same standard of living for the rest of their lives. So if it's spouse, then till the spouse's life expectancy, and if it's children, then the children till they are adults and on their own, right? So one is it covers the future expenses. So there's a large enough corpus which they can draw from and continue to live the way they were living before. The second is if you have children and you have planned something for their education, maybe for their marriage, if it's critical goal to you, then you need to add that corpus also to the amount of cover that you need to take. And the third is simple. If you have loans on your head, it's a very good idea to add that to your insurance cover. So if I put these three things together, this is the amount of insurance that you need. So let's say these add up to 4 crores for somebody. What you can possibly remove from it is what you have already done in terms of your investments. So let's say your investments that are available to the family add up to about 1 crore of rupees. So 4 crores is what you need. 1 crore is what you've already accumulated. So 3 crores will be your life cover, right? So do a little bit of working around it rather than just say, okay, my income is so and so, so let me go for 10 times cover. That's not bad. That's not bad in the sense that you'll at least end up taking it, but do a more personalized calculation before you go ahead with life insurance. Insurance is an expense. Get this straight. So with a lot of people I talk to and I say, you need a 1 crore cover, it's going to cost you 15,000 rupees a year. And they say, okay, so I will pay till 60 and what will I get after 60? I said, nothing. You will not get anything because it's an expense. And they don't like it. It's almost as if, you want to die to be able to get that 1 crore. So it doesn't work like that. It should not work like that. You don't want your insurance cost to materialize. Trust me, you don't want it to materialize. So just like you have your living expenses and you spend on shopping and you spend on dining out, consider insurance just like any other expense, right? So buy it because you need it. Don't buy it for tax saving purposes. Don't buy it for investment, right? So in life insurance, you have a bunch of policies. There's money back, endowments, ULIPs, and so on and so forth. What you really need is a plain term cover, which just says that you pay us this amount of money every year, and we will protect you till a certain age. And typically this age could be close to your retirement, right? So you decide maybe 60 years. So we will cover you till 60 years, so long as you continue to pay this money. So if anything happens to you, we will give 1 crore to your family, right? That's exactly how life insurance should work. So don't confuse it with investment. Don't get into the investment bit. Now, why some people may not require life insurance because of the stage of life or because how they are in terms of dependence and all that. I think health insurance is something which is absolutely critical for anybody and everyone, right? So health insurance covers hospitalization expenses. So if a person is hospitalized, stays overnight in a hospital, that's when the health insurance piece kicks in. Now, while you're young and you're employed, there is a good chance that your employer will cover you through a group insurance. So if you have a decent coverage to start out, even if you have a 2-3 lakhs cover, you're still young and 20s, late 20s, etc. I think it's absolutely fine to just continue with that and not bother with a personal cover. But I would think as you reach your late 30s, early 40s, that is the time, not even early 40s, I'll say mid 30s to late 30s, that is the time you kind of supplement your medical cover of the company with a personal medical cover. So this is cover which stays with you irrespective of whether you lose your job tomorrow or you're employed with someone else who doesn't have a group insurance and stuff like that, right? And build on this gradually, because medical costs are inflating. So you may take a cover of, let's say, 5 lakhs today, but it's not going to hold good 10 years from now, right? So look at what kind of costs that typically what one would have to incur in the place where you live. So for example, if I live in Bangalore and if something happens to me, I want to be treated in a Manipal or a Fortis or an Apollo or that category of hospitals, I need to plan my medical insurance accordingly, because these guys are going to charge me much more than what an average hospital would. So I would possibly start with a 15-20 lakhs cover, right? So no amount of health insurance is enough. I think it really depends upon your affordability. So I know people who've taken 50 lakhs, 1 crore of health insurance, especially, this whole crazy thing going on post-COVID that, anything can happen at any point in time. Which is fair, I think, which is absolutely fair. So for the ones who are, absolutely conservative, have gone with very high medical covers. But I think 10 lakhs living in a city in any of the metros or tier 2 cities, I think 10 lakhs is a good cover for anybody to have at any point in time. Make sure you cover your parents if they are not covered. It's usually subsidized under the group insurance. The added benefit is you get tax savings. But again, tax savings is not at all the criteria for buying a health insurance cover. It's just an additional benefit that you get. There are a bunch of other covers that one can look at. So critical illness. So if there's history of critical illness in the family, heart related, kidney related, or whatever else, it's a good idea to either take a CI cover, but what I usually recommend people to do is have an additional medical insurance. So if there's a critical illness in the family, there's a history, and you're having a 10 lakhs medical cover, I would say that ramp it up to about 25 lakhs instead of taking a 15 lakhs CI covers, because CI covers typically stop once, you've used it once, but your medical insurance will ensure that even if you use that cover, you're going to be back to 25 lakhs. So I usually, this is just a tip you can use, that it's a good idea to keep ramping up your health or medical insurance instead of taking a separate CI cover. But there are, of course, multiple of them available in the market. The other thing is personal accidents. This is basically, to take care of any kind of disability. So life insurance is for death. Personal accident is for accidental death. And more importantly, it's for any disability caused due to an accident. Most employers cover their employees for PA. So typically it is 2 to 3 times CTC, 5 times CTC for senior level people, etc. If you don't have it, again, this is a good policy to have, right? Then there's home insurance. So if you have you're owning a property and you think that it makes sense to cover the structure of the property, you have expensive contents in the house, there's something called home insurance, extremely cheap cover, but I would think it is useful, more so for people who live in independent houses. So for example, a place like Chennai, had the flood situation so many times. It does make sense to buy home insurance. And of course, there's car insurance. So I don't have to talk about that because, the government makes sure that everybody who owns a vehicle has some kind of uh, insurance, right? So I'm not taking any questions yet. I'm not even looking at what you've put in the chat. Let me just finish my talk and then we open it up for questions. Now we come to the fourth pillar, which I think is also very important. So we talked about saving, but we didn't talk about what do we do with those savings. So post demonetization, you no longer have the option of keeping money under your mattress, right? But let's say even if that option was open, it doesn't help because your money is going to lose value. So the 100 rupees that I have today is not going to be worth 100 bucks even a year down the line. And this happens because of something called inflation. Now, all of you are privy to inflation. Just go back and think about what you paid for dosa when you were in college vis-a-vis what you're paying now. So the regular stuff that you use right now was much cheaper even 5 years, 10 years earlier. And this is exactly what inflation does to your money. So the value of money keeps going down over a period of time. And that's because the expenses keep going up on account of inflation. So what I'm spending now is going to be able to buy me much lesser tomorrow on account of inflation. So average inflation in India is right now about 4 to 5%. There could be lifestyle inflation for some people. So, certain families may tend to spend a little more on lifestyle expenses. So their inflation rates could be as high as even 10%. Education typically commands a higher level of inflation, right? So education costs typically go up in India by 10-15% every year. So the thing is, now I have saved the money and let's say it's not growing at all, then I'm a loser in the sense that there's very little I'll be able to do with that money because it's not earning anything more. So while it is very important to save, I think it's more important to invest that money. So the objective of investment is for your money to be able to earn a little more so that you're able to take care of this invisible killer called inflation, and you're also able to set aside money for the important milestones in your life. So now let's look at what happens when we actually invest, right? So possibly some of you have heard of Einstein saying that compounding is the eighth wonder of the world. Frankly, I don't know if he said it. I don't even care if he said it. But the fact is, when you put a picture like that, that statement gains a lot of weight, right? And it is truly magical. And uh, I don't know how many folks have experienced it, but I'm seeing that with my clients who have now been working for 20, 25 years, or the ones who are closer to retirement. And it's really fascinating to see how their employee provident fund is growing or has grown, how their PPF, public provident fund, is growing. So compounding is a very basic concept, right? I mean, I think we maybe learned it in our fourth, fifth standard maths, that when you invest an amount and it earns some interest in the first year, the next year you will not just get interest on the principal, but you will also get it on the interest that you earned in the first year, and this cycle will continue. So basically, earning interest on interest is called compounding. Now, some of you would have come across literature around mutual funds and SIPs and power of compounding. I think it is a little misplaced there, but we could have that discussion separately sometime. But the idea is that typically it's very easy to associate compounding with something which has a fixed rate of interest. So for example, I invest money in PPF. PPF pays me, let's say, 7%. So every year, the money that I put in earns 7. And this, at the end of the year, whatever corpus is built, the next year it will again earn 7%, and so on, right? So it's amazing what starts happening to that money after you have invested for 10 or 15 years, because compounding really kicks in. The magic of compounding kicks in after a certain period of time. So I have so many clients now whose EPF interest is way higher than the contribution that they are making every year. That's because the corpus has grown so much that the amount of interest that they earn is absolutely huge. So let's just see three things around compounding which possibly could make sense to you. If you save a little more, right, it grows in value a little higher. So for example, if I start with 10,000 rupees and I invested, I don't know for what period, 10 years or something, whatever, 25 years, it grows to about 8 lakhs. So my 3 lakhs becomes 8 lakhs, which is fine. If I do a little more today, it grows to 12 lakhs. Now, of course, the multiplier is the same. And it's not that, this 500 is earning a little more. It's still earning 7%. But the fact is that if you stretch, right, like I talked about stretch target on savings, if you're just able to push yourself a little more, the result is quite good, at the end of it. So the one thing is, the more you save, the more that corpus kind of grows to. So stretch is very, very important. The longer you invest makes a difference, right? So let me get to this one second. Yeah. So let's say Ram starts at 28, Sham starts at 48, 20 years later. Ram starts only with 5,000, Sham starts with 15,000, because he's lost all these years of not saving. Let's say both of them earn 12% and both invest till the age of 58. Now the total investment, if you calculate in both the cases, is 18 lakhs, but you see the power of compounding here, right? So the guy who starts late, despite the fact that, he's able to multiply the amount of savings that he could have made in early years, the difference really comes from the time that money has been invested. And that's why I like some of these products like public provident fund. It's got a 15-year lock-in, so you have to invest for 15 years, because that's where you really see the magic happening. If a product is just 3 years or 5 years, you don't see that happening and you are too tempted to pull out. So stick to some of these things like EPF, PPF, etc. They are not bad at all. So the longer you invest makes a difference. The more you earn makes a difference. Now, this is the piece which gets us to where I should be putting my money. So I'm saving, which is great. I'm also willing to invest, which is great. I'm going to have a stretch target on my savings, which is also great. But where should I put in my money? So now look at this. Obviously, each extra percent return that I can earn on my money is going to have a compounding effect on my return or the corpus. Because what happens is when I'm investing at 5% vis-a-vis investing at 10%, I'm getting a compound interest additionally on that 5% that I'm putting. And then that grows into a substantially huge corpus. So now if you see the multiplier here is about 4 times, and here it's about 8 or 9 times, right? So let's get to this bit now, that where is it I need to invest to be able to get, any kind of return. So I believe all of you are familiar, with this saying that higher the risk, higher is your return. Lower the risk, lower is your return. And higher your return, obviously higher is going to be your risk. So the entire, gamut of investments that are available today for us can basically be placed on a risk return matrix to see which one is a low risk low return and which one is a high risk high return. So I'm not one for the other, and uh, that's why it's very important to have a little bit of everything in your investment bucket, right? So basically, broadly, I'm sure there are more than these, but at a broad level for everyone's understanding, I've classified investments into 4 buckets. So you have the fixed income debt bucket, you could have real estate, you have equity, and you have gold. If I were to put these on the risk return matrix, I think fixed income debt will be relatively low risk, low return. Gold will be somewhere in the middle. Equity will definitely be high risk, high return. And real estate also would be somewhere in the middle. So I'm not a huge fan of this one, but yes, a lot of people swear by real estate. All the money goes into property. So let's look at these one by one. Now, before I get into, I don't have time to go into individual products. This is just to give you an idea of what are the options available under these categories. See, the more important thing is not going to be your choice of product, right? So a lot of people get stuck with acha ye scheme acha hai mutual fund ka ya wo scheme acha hai, right? So should I go with the Axis or should I go with the HDFC? Should I go with a large cap or a mid cap? While those are valid questions, they really do not matter over long term. What's going to matter over long term is how you're going to build this pie, right? So how much of your allocation you want should be in equity, how much are you going to keep in debt, how much are you going to keep in gold, and real estate for the moment let's just keep aside because it's a largely illiquid asset, right? So how you decide this allocation will depend on a variety of factors, right? So, and it's going to be different for each individual, right? You cannot say that, acha, if your age is let's say 40 to 50, to 50% equity mein dal do. Because 100 minus your age should be equity, I think is best just a thumb rule and should be can be trashed very easily. Because if I have a person who's 30 years old but who can't sleep well if his 100 rupees becomes even 95, then equity is not an asset class for you. So if you're going to lose sleep over your investment, you better stay away from it, right? So it's absolutely got nothing to do with your age. Although if you are young, you can ideally take more risk because you have more time to kind of recover your money. So that's the funda behind that thumb rule of 100 minus your age is your equity allocation. I don't think it's that. It depends on what are the goals that you're planning for. As it what is it that you really want to do in life? It would depend upon your risk profile. How much risk are you willing to take? What kind of person are you when it comes to how to your reaction when your investments behave in a certain way. So there also comes in the portion of psychologically. So it's not pure maths. I think it's a lot of psychology, and what is your association with money, what is it you've seen your parents doing. I think all this plays a very critical role, and that is why we have some very smart young guys still sticking to LICs and fixed deposits, despite there being a large number of options today to invest your money very wisely, right? So it will depend on a lot of those things. If you crack this piece correctly, I think you've solved the investment puzzle. And then within that puzzle, let's say equity, you chose fund A over fund B and fund A didn't do so well. It really doesn't matter. So long as you get this piece correct, that how much do I want to allocate to this whole bucket? I think that's where you have kind of solved this puzzle. So this might require some help, or this might require some self-study and all that, but trust me, it's worth doing, and you will get it over a period of time. You're not going to get it right on day one. So some of the things in fixed income, could be your savings fixed deposit. There are post office schemes like NSC, senior citizens, for senior citizens. There's provident fund. Your provident fund falls into the category of fixed income. There are debt mutual funds. There are RBI bonds, corporate bonds, and stuff like that. Oh, I missed. Yeah, PPL. Now a lot of people, for example, you will see this a lot with mutual fund distributors, that they'll do a comparison. If you invested in PPF for tax saving vis-a-vis if you invested in a tax saving mutual fund, the returns are so different. Yes, they are different, but I think PPF is an absolutely fantastic product, and everyone should have it in their portfolio as a part of their fixed income pie. So let's say, your PF takes care of your fixed income, then I'm not saying that you do PPF. But if there's potential and there's room for you to add more money into the fixed income bucket, I think public provident fund is an absolutely wonderful product that you should have. There is no point comparing it with equity, because you're doing apples to oranges comparison, right? So you have to look at, within that bucket, what are my options in terms of liquidity, returns, and when I need the money, and then you decide what needs to be done. Next is real estate. Now, I'm of the view that one should own a property only if you're going to live there, and there is no need to accumulate properties and assets over a period of time. A lot of wealthy guys tend to do it because they have a lot of money and they don't know what to do with it. So they will buy 5 houses in 5 different cities. So that is a different thing. But don't buy property for investment, unless probably it's a land which you think can do very well and all that. If you're buying a house property, buy it because you want to live there and not for investment. So that's my take on real estate. You could think of it differently. Equity is a very interesting asset class, and if you tell me today that I don't understand stock markets, I don't understand mutual funds, I don't understand any of it, it just doesn't make sense to me. I mean, then you're just plain lazy, because today, if you want to know about anything, there are humongous channels which you can look at. There's informational content on YouTube. There are courses, your Coursera, and whole lot of them. There's content which is available on subscription basis, which will tell you just everything that you need to know. There's a lot of free content which will give you amazing insights into how these things work. So today's day and age, if you say that you don't know what these products are and how they work, it just doesn't cut the ice. So, do your homework and get started with this, because this is where you will actually be able to build your wealth, right? None of these perhaps will be able to do it for you. So this is an investment bucket which will just keep up with inflation. So today we are seeing that interest rates have gone down to as low as 3 to 5%. My FD is giving me 5%. It used to give me 10% earlier. That is because inflation is low. So if we have an era of 1 or 2% inflation, we are going to see 2 to 3% returns on this, which we know is not going to be enough for us. And that is where equity comes into picture, because possibly this is the only asset class which, if invested wisely into, can give you inflation beating returns, right? I'm not talking about trading. I'm not talking about gambling. I'm actually talking about investing into equity. And then there's gold. So yeah, I mean, Indians have this fascination with gold. I also think it does make sense to put some part of gold into this pie, maybe a 5% or a 10%, etc. Even in gold, there are various options of doing this, and there's enough material available now if you want to know about any product and how it works, etc. And if you're not able to do it yourself, just seek professional help. It just makes sense to do it, but don't shrug this away thinking, yaar, mujhe to sirf FD pata hai, ya mujhe sirf LIC pata hai. I mean, gone is that time, where you could say such things and get away with it. And after all, it's your own money and your own finances, right? So you are the one who will be responsible in the end, right? So get this piece sorted out, and this will require a certain amount of self-study, which is worth doing. So yeah, so that, okay, so I've just exceeded my time. I think I will take 5 more minutes and then we will kind of open it up for questions. Most of this I would have already covered, so I'm going to run through it real quick. But just to kind of summarize what we did till now, so there are 4 basic foundational pillars, which if you set right in your financial life, there's very little chance that you will go wrong. Of course, you can't be 100% right, but If you have your savings planned in such a way that they are working towards certain milestones for you, or even if you have a savings plan and you're investing somewhere, that's good. Second is you have an emergency fund in place. Third is whatever insurances you need to cover risk to your life, health, property, etc., that is in place. And the fourth thing is that you have a investment bucket which is allocated as per your risk profile and your needs, right? And you are sorted. As easy as this sounds, it really isn't, right? So it takes years to kind of get these pieces in place. But I think the first three can easily be done. There's very little to do. You have to just do it once and you're sorted. Investment is the piece on which you will have to spend time and kind of, hone your skills. Okay, so common mistakes we discussed about that you're spending before you're saving. The second thing is you invest only to save tax. Again, bad idea. Combining insurance with investments, bad idea. Just stick to term insurance for life insurance, and that's good enough. No provision for contingency. So whatever has come has either been spent or has been put into high risk assets which you cannot touch, or has been locked in real estate. So you need to have enough liquidity available at all times. Maintaining huge balances in savings account, until last year I could say that it was a bad idea, but let's look at the situation today. There's a IDFC First Bank which was paying about 7% interest until last month on their SB account, and now they are paying about 6%. If I invest in a debt fund or an FD, I'm averaging about a 4-5% return, right? So I might as well use a savings account right now of IDFC as my debt part of the portfolio. So that aside, that's just one situation we've landed up into today. But typically, seeing money readily available with you generally brings this tendency to spend it, right? And that is why it's very important that your operational or running account should not have any money just lying around without use. Okay, investing only to get a high return. So I think I stressed on this bit that it is your savings which will ensure that you create wealth over your lifetime, and it is not your return. And let me tell you, a high return, people often throw these things like, I want a 40% return, I want to double my money in 3 years. See, these things may happen for you once in a while in your lifetime if you're damn lucky, you're in the right place at the right time and you made some right moves. But it just doesn't work like that. And at some point of time, it will kind of average out owing to what your investment did at a different point in time. So high return is not your criteria. You have to look at how much you need to earn to be able to do everything that you want to do in your life. So let's say for me today, if all the goals that I've set for myself are possible at a 8% return on my corpus, why should I go overboard with fanciful stuff and getting high returns and stuff like that, right? So high return means nothing. You have to see what is the return you need to generate on your investments to be able to do everything you have set out for yourself. High level of income does not translate into high level of wealth unless it leads to high level of savings. Okay, this bit I didn't cover. So in terms of loans, right, the liabilities that you take, if I were to just put it on a scale, a home loan is the best loan to have because it's the cheapest. It is for building a useful, good asset, and it brings you a good amount of tax savings. So I'm absolutely open to taking a home loan when you want to buy a property. It's not a bad thing to do. Car loan is avoidable if you have the money. So let's say you have 10 lakh rupees sitting with you in cash and in your bank account, and you want to buy a 8 lakh rupees car, there is absolutely no harm in using all your money instead of taking a car loan, because car loan is only going to add to the cost of your car, which is a depreciating asset. The moment you get it from the showroom to your house, it's already depreciated by 10%, right? But if you need to, if you don't have the money and you need to buy a car loan is okay to have. The next on the line is personal loan, still better than a credit card loan, but avoidable at all costs, in the sense that people take personal loans for things like vacations or buying a high-end fridge and stuff like that. So don't do that. If you want to do it, first save for it and then reward yourself, right? So save for a year and then go for a vacation that you want to. But if you have to do it, again, don't do it using your credit card. A personal loan is still cheaper. It will come at 12-13%. And credit card is an absolute no-no. So if you are in the habit of spending on your credit card and carrying forward that balance and paying it every month, my first recommendation would be to stop using the credit card altogether, right? Second would be that whatever is your pending loan on the credit card, convert it into a personal loan and then pay it off. So, while credit card is a very useful thing, how you use it is more important, right? So if you're spoiling your habits using a credit card, you are overspending, then it's an absolute no-no. So if you've got into a debt trap with respect to your credit card, the first thing you do is trash your credit card. Second thing you do is pay off everything that is there, taking a personal loan, right? So a credit card loan is absolute no-no. The other thing is worrying about the macro picture, right? So you're too worried about what's happening around you, what's happening to the country, stock market itna upar kyun ja raha hai, what's happening to the government, acha farmers ka kya ho raha hai. This is all good, for having the coffee table conversations, but this should not lead to you making decisions about your own money, right? So look at what's happening in your house. Look at what's happening to your income, your expenses, your savings. Don't worry about things which are not in your control. So this is just to indicate that you worry about stuff which is in your control and you just read about stuff which is outside of your control, right? You don't have to worry about it or take decisions around. Okay, believing real estate is the best. So to each his own. I've found enough number of people who think it is a very good investment option. In my experience, it is not, but you may have different experiences. Okay, quickly on financial planning, because I'm a financial planner. So we've actually covered all aspects of financial planning when I just spoke to you about it. What a financial plan does is it kind of weaves all these things together, right? So just like you make a mala, right? There are different motis and you put them together and you have a nice looking necklace. So a financial plan is exactly that. It is like a roadmap. It takes into consideration all aspects of your personal finances. So, what are your cash flows? What is it you've done in terms of your insurances? What are the milestones that you need to plan for? How are your investments doing? What is it you have done so far? What is it you need to do in future? Do you have a will in place, right? So, a financial plan does exactly that. So, you may not start with a financial plan. And let me tell you that financial planning as an exercise, I have done it for people in their 20s and I know it doesn't work because that mindset is not there. I think a good time to have a financial plan in place is when you are fairly settled in your career, fairly settled in life, right? Whatever that life may be. I mean, you can choose to not get married, not do the regular conventional stuff, which is absolutely okay. But you have a far better vision of how you see your life. That is the time to look at doing it on your own or perhaps hiring a professional to do it. So financial plan is basically that. So it looks at what are the different milestones in your life and how are you going to reach from point A where you are today to point C, D, E, F, whatever you want in life. So it's as simple as that. Yeah, so these are the things a financial plan would typically cover. In fact, everything that I discussed with you today is in the scope of financial planning, and there is a little more, right? But if you get those things right, I think you're largely sorted. So I'm going to, sorry guys, I took almost an hour, but I'm going to end with, this is my last slide. And it's just a summary or reminder of whatever we've already discussed. So the first thing is that you need to have a contingency fund in place, plan between 4 to 24 months of expenses, depending on how your personal situation is. Next is insurance. So see which insurance is applicable to you and just make sure that it is in place. The third thing is start early. I still remember as a kid, our parents got us this Santa Claus piggy bank. And I used to fill it with coins. And every few weeks, I would see, okay, what is the level? Maybe open it up, see, oh, I have so many coins. And, when it would actually fill up, there is this huge high or thrill. Oh my God, I have so much money. Trust me, it works exactly the same when you look at your overall wealth or investments, but it has to be built coin by coin and piece by piece. So the earlier you start, the better it is. So as soon as you start earning, you may save 500 rupees for all I care, but it's very, very important that you start saving as soon as you start earning. So don't ignore inflation. Don't look at only LICs and fixed deposits because they are just going to be able to cover your expenses at all points in time. They are not going to be able to give you that little extra for the more important milestones in your life. And definitely they will not help you retire early. If you want to retire early, you have to build wealth faster. So I'm not saying take undue amount of risk, but just plan your investments better. Diversify. So we looked at that pie, that don't put everything in one basket. That's very important. Invest with some amount of discipline and consistency. I think that is very important. So you may invest 5,000 a month every year and continue the same thing for 5 years is absolutely okay. That you're not increasing it and stuff like that. But the fact that you're doing it every single month without fail, that is the one which is going to make a huge difference. Okay, this is absolute critical advice that if you don't understand something, do not invest in it. Do not just sign a piece of paper which somebody gives you promising the world to you. It does not work like that, right? And I see this a lot with insurance policies, that people don't understand what they are getting into. Whatever they are told, they will take it at face value and go ahead with it. So spend little time, spend at least half an hour, 1 hour researching the product, asking the right kind of questions, just so you know that if you have made that choice to go ahead with it, that choice has been yours. And if something goes wrong, the onus is on you and you don't have to point fingers at all and sundry that this guy sold me the wrong product, etc. Right? So you cannot do that. So if you don't understand it, don't go ahead till you have understood whether it's good for you. Needless to say, review your financial situation, review your investments, not very often, not every week, every month, maybe once in 6 months or even once a year is good enough. Hire a professional if do it yourself is not your cup of tea. See, unfortunately, finance or personal finance has been such a field where we've been getting advice from everybody except a professional. Luckily now in this generation, things are changing and people are okay to hire professionals and pay a fee and stuff like that. But usually you would get your financial advice from your parent or your uncles or your friends, etc. Now remember, their life, their situation, the environment in which they live, the country in which they live was very different from where we live today, right? So not necessarily that what was good for them will be good for you, right? So figure out what is good for you and go ahead with it. All right. So I am sorry that I have taken too much time, but now I'm open for questions. Okay, so I'm just going to stop sharing my screen so that you can see my face again and I can see the chat. Okay. Yeah, Nisha, over to you. Sorry, I overextended by 15 minutes.
Sure, no problem. Thank you for an absolutely brilliant session, Neeti. You debunked a lot of myths around money, at least in my mind. So we are open to questions now. We actually have a couple of questions. Deepak, do you want to go ahead and ask your question?
Yeah. So about the personal health insurance. So the other day I was browsing through Policy Bazaar and I got to know that there are some health policy which actually provide a cover up to 1 crore even. And that too at the same price as what cover you get, say, of the 10, 15 lakh or 20 lakh maybe. So do you think there is some catch in such policies which give you very high coverage? And should we avoid that or like?
So not necessarily, Deepak. Having said that, somebody giving 1 crore cover at a price of a 20 or 30 lakh, I would definitely want to go a little more to compare those two policies and check what is different about it. I think what is more important when you pick up health insurance is who is your health insurance provider, because everybody can give health insurance, but the more important thing is the servicing bit and the claim bit, right? So there are some companies where people have had nightmares, when there is a claim or let's say policies for renewal and they want to include their child and stuff like that. So I ideally don't want to take names here, but there are 3 providers in the Indian market. I will give out the names. So there's Max Bupa. There used to be Apollo Munich, but now HDFC Ergo has taken it, and I've been hearing not so good things about servicing and stuff. And there is Star Insurance. So these are guys who focus on health insurance products. So it may not be a bad idea for you to evaluate, what is it they have to offer, because in terms of servicing claims, redressal of whatever doubts, etc., these guys could be much better than some new age guy who's giving you a 1 crore policy for a paltry premium. So I think, and if you can go through an agent, that also is not a bad idea, because in health insurance, it doesn't matter that you go through an agent or a company. So let's say you have somebody in your family, in your circle, who does health insurance business and who will be available to you when you want to file a claim. I think that is very critical. So usme then it's fine whichever company he has, so long as he's a trustworthy person and he will help you through it. So do a little bit of research. Don't go just based on who is giving me the highest cover for the cheapest amount, because when you read the fine print, it will look radically different in different policies.
Okay, thanks.
Thank you, Deepak, for that question. Dhananjay, you had something to ask.
Yeah. So it was good session.
Thank you, Dhananjay.
And thanks for that. So you mentioned about various investment instruments like stocks, mutual funds, equity funds, PPF. So what I wanted to know was, how can we decide how much to allocate for each of this instrument? How much percentage, of monthly saving or?
Dhananjay, I really wish that there was a thumb rule that I could give you, and it was as simple as that. But fact remains, it is not, right? So, if I may ask, how old are you, and do you have kids or you're married? And just give me, I mean,
Yeah, I'm
quick idea.
I have one daughter.
Okay. So then it is important for you to see, your overall picture through a financial plan. See what are the things that you need to plan for. Like I said, see, the way it works is I have to do 5 things in terms of goals in my life. Let's say it's my daughter's education. I need to plan for my retirement, and I need to do these 2-3 things, whatever they are, right? Now I look at that in order to do all those, what is the return that I should earn on my money, right? Like I said, let's say it comes to a 10% in your case, right? Then you do the backward calculation. Acha, 10% return hai to, if I put all my money in fixed income debt, I'm going to get only 6%. That means I need to take additional risk. So which means that I need to put some money into the equity bucket. And that's how you arrive at an asset allocation. So I'm not saying it is not possible to do it yourself, but if you sit with an Excel sheet and do it yourself, it's going to be tough. So there are a lot of platforms which allow you to build your financial plan, maybe free of cost or even for a small amount, and help you decide your asset allocation. Feel free to use those tools. Don't think that this knowledge will suddenly come to you one day and you will be able to decide, oh, what is right for me. It's not going to work like that. नहीं तो किसी फाइनेंशियल प्लानर को कांटेक्ट करो, सीक हेल्प ऑफ अ पर्सन हु कैन सिट विद यू एंड मेक यू अंडरस्टैंड दैट दिस इज व्हाट नीड्स टू बी डन. आई विश आई कुड टेल यू इट्स एज सिंपल एज अच्छा इतना इक्विटी में डाल दो, इतना डेट में डाल दो, बट इट्स रियली नॉट दैट सिंपल, एंड इट इज एब्सोल्युटली योर पर्सनल सिचुएशन व्हिच विल डिसाइड व्हाट काइंड ऑफ. So I don't even know how much risk you can take. Let's say you cannot sleep well because you've invested in equity. Then equity is out for you, right?
I think one additional thing I would like for myself is, so at times I feel I am over invested in stocks, and I am probably not at all or very little investing in other things.
Okay, so that question I will be able to help you with. So let's say you have come to a stage where you have decided an asset allocation, and let's keep it a simple 50% of my wealth or money or my investment should sit in equity, 50% should sit in debt. That is what you have agreed should be your asset allocation, looking at your risk profile, what you want in life and all that. Now let's say because the markets have moved up, your 15 equity has moved to 60. Right? So now the tilt is in favor of equity. So now this is a short indication to you that book 10% profit and push it back into fixed income and go back to 50-50. Let's say the market's correct and your 50% has become 40%. This is an indication to you that move money from fixed income bucket into the equity bucket. So what are you doing? You're selling when equity is high and you're putting more money when the equity is low. So there is very simple logic to it. There's nothing intuitive about it, right? So once you've decided your allocation, if you largely stick to it, I think you will take the right decisions with respect to over investment, profit booking, loss ke time kya karna hai. So just stick to your allocation and that will take care of it.
Okay, thanks. Yeah.
Yeah.
Thank you, Dhananjay, for that question. Thank you, Neeti. Do we have any more questions from the members? Or does anyone want to add anything?
Yeah, I have one doubt.
Sure, go ahead, Ravi.
Yeah. So in my case, my spouse is not working. So what is the basically what would be the ideal legal advice where we invest on her name? Basically, I invest on her name and park it in the fixed deposit. So I have gone through clear text, and it says you should transfer based on gift money, and that is also it's saying it is twice in a year. That's the so in case of any audit it will be
yeah. So see, there are in income tax, right, there's something called a clubbing provision. So a lot of people, what they do is that because the spouse doesn't fall into the tax bracket, they will transfer some money to the spouse and invest in the spouse name. So the interest, etc., returns will go in her name. And since she is not taxable in the taxable bracket, that income kind of escapes tax. Now, IT does not look at this, very well. So I would suggest that is not the right thing to do. You can, of course, gift the money. So, gifting is absolutely allowed and there is no tax on gifting. But if she invests the money to earn a return, then it will have to be clubbed back with your income. I mean, that is the most right thing to do and which will not allow you to fall in trouble. So if she uses that money, let's say to start a business and the business generates an income, then it is fine. Then it is her money. It is out of, her skills that she has earned that income. But if you are using that money to invest in the stock market or buy fixed deposits, whatever returns you earn on it will be taxable in your hand. So I would advise against, doing such a thing. So one way of looking at it is, let's say you have fixed deposits which run over long term. You can replace them with debt funds, right? So you invest in debt funds in your name, and debt funds taxation does not arise so long as you don't sell. So let's say वो FD भी आपने ऐसे ही रखा हुआ है 5 साल तक, and it is earning interest, and that interest you have to pay tax because TDS gets deducted. It comes in your 26 years. You replace it with debt funds, of course, safe debt fund, where you get a similar kind of return, but so long as you don't touch it, there's no tax implication at all. So I would think be on the right side of the IT guy, you don't want to get into trouble. Clubbing provisions will definitely get attracted in this case.
Right. Yeah. Thank you. That answers my question. And just one more doubt. Recently, I'm blessed with a little son. So
Sorry, what's that?
Recently, I am blessed with a kid.
Oh, good. Congratulations.
Yeah, thank you. So I was researching on the minor account.
Mm-hmm.
So how does that work?
Good idea. So I have a minor daughter as well. She's 3 years old. So what I did was that we opened a bank account for her. You can easily open a minor account for your child as a guardian. Whatever gift money she receives over time can ideally go into the bank account. I also started a mutual fund in her name. So you can start investment for minor. It only needs a guardian. You or your wife can be a guardian and get started. So that's absolutely critical to do. You should do it. So start as early as now, so a lot of money comes to children in various forms over time. And, we don't tend to save it, wo yahan wahan kahin spend ho jata hai. Instead, you have a formal arrangement where you have a bank account or you have mutual funds where you're putting her money. So even outside of what you will do for her as a parent for her education, etc., you will realize that this kitty itself, through gift money or whatever else which she gets, also becomes a substantial, saving. So do that. As a minor, you can open her account, you can open her investments. It will only need a guardian, nothing else.
So again, what will be the cap on gift money that we give?
There is no cap on gift money. There's no
Okay.
upper cap on gift money. Absolutely nothing. For blood relations, there's no cap on gift money.
Okay, cool. Thank you.
Okay.
Thank you, Ravi, for the question. Do we have any more questions?
Hello, this is Ketan.
Yeah, hi, Ketan.
So, Neeti, what are your views for NPS?
Good you brought it up. I think it's a great investment now than it was earlier when there were a different set of tax provisions. So basically, for those of you who may not know, NPS is basically the national pension scheme. It's a kind of pension product which was introduced by the government. It's mandatory for the government employees. So they have kind of moved from PF to NPS. But for private sector, you still have an option that you could do PF or NPS if your company is offering. Or you just stand alone on your own, go ahead and open a NPS account. So the way NPS works is that up to the age of 60, you can keep putting money into NPS account. There's no upper cap. I think the lower is about 6,000 a year or some such thing. I mean, it's insignificant. There's no limit on how much money you can put. The good thing about NPS is you can actually decide your asset allocation. So it allows 75% investment in equity. There's corporate bond investment, there's GSEC investment. So there are these different plans, E, C, G. So you can decide how much allocation you want to have to each of these. So I think for your retirement goal, EPF, which is your provident fund, if you're self-employed, then maybe PPF plus NPS can really work very, very well. So at the age of 60, you can take out 60% of the money without paying any tax. The remaining 40% has to be mandatory pension. If you can start NPS early, and early I will say if you start in your 20s or 30s, nothing like it, but even if you have like 15 or 20 years to go before you turn 60, I think it is definitely worth looking at it. The other thing is NPS also provides a deduction under this a section called 80CCD, where up to 50,000 rupees a year you can take a deduction for the investment into NPS. So I think, Ketan, it's a great product. One definitely must consider putting money into NPS. See, I like these out of sight, out of mind kind of products, which is like Provident Fund, PPF, NPS, because you keep putting money inside and you don't disturb it for anything. And it is important to not disturb it for anything, for the compounding aspect to kick in. That usually doesn't happen with the shares or a MF or an FDs, which are very easily accessible for liquidation. So if you can get into some of these long-term products and have consistency with it, I think it's a great product.
Thanks, Neeti. Thank you.
Thank you, Ketan. Thank you, Neeti, so much once again for such. So I think we would be concluding this session for the day, unless we have any more questions or any views. Does anyone want to share anything? Okay. So thank you, Neeti, once again for such an informative session. And we look forward to having you on more of our sessions. Neeti, you could probably drop your details so that our members could reach out to you personally.
I'll do that. Thank you, Nisha, for moderating this so well. And I think it was a very fruitful 1.5 hour for me. I don't know for the audience, but I absolutely enjoy doing this. So thank you so much for having me over.
Likewise, Neeti, look forward to more sessions by you. Also to all our members, next week on Friday, we have a Gupshup session around the pharma and healthcare industry. So don't miss it. All right. Thank you, Neeti.
Thanks,
Bye-bye.
everyone. Have a great day.
Thank you, everyone.
Thank you. Bye-bye.
Thank you.
Bye.